Picture the chaos of October 1929. Wall Street in pandemonium, fortunes vanishing in hours, families ruined overnight. Black Tuesday. The Dow plummets 13%, igniting the Great Depression. Fast forward to today. Tech giants like Nvidia skyrocket, AI hype fuels trillion-dollar valuations. But here's the paradox. What if the ghosts of 1929 are whispering warnings of a 2029 meltdown? Are we blind to the bubbles inflating right now? Tonight, we unearth a forgotten crisis that mirrors our own and predicts impending doom. To understand the threat, let's revisit the roaring 1920s. America boomed post-World War I. New technologies like radios and cars sparked wild optimism. Stock prices soared on easy credit and speculation. By 1929, the Dow had tripled in 5 years. Sound familiar? Today, in 2025, the S&P 500 hit 6,625, up over 13% year-to-date. AI and tech drive the surge, with Nvidia's market cap topping $3 trillion. Quick stat: global debt stands at $111 trillion, 95% of world GDP coing the 1920s debt-fueled frenzy. Relatable analogy: it's like buying a house with no down payment, betting prices will climb forever. But when the music stops, someone gets left without a chair. In 1929, over-leveraged investors and banks set the stage. Now, with U.S. debt at $38 trillion to 125% of GDP and Shiller PE ratio at 39, history rhymes. How did the 1929 bubble form, and how does it parallel today's? Let's decode with metaphors. Imagine the market as a house of cards. Each layer is speculation built on borrowed money. In the 1920s, margin buying let investors borrow 90% of stock costs, fueling artificial highs. Today, low interest rates post-pandemic pumped trillions into markets. Metaphor: it's a balloon inflated by hot, greasy-fed money and AI hype. Step 1. Overvaluation. 1929's PE ratios hit 32. Now Shiller PE is 39, second highest ever, rivaling .com peaks. Step 2. Debt spirals. Banks lent recklessly then. Now global debt tops $324 trillion total, with US at $38 trillion. Like a snowball rolling downhill, it grows unchecked. Step 3. Tech euphoria. Radios and autos were the AI of yesteryear, promising endless growth. But reality bites, overproduction led to crashes. In 2025, AI investments surge, but warnings abound. Wall Street CEOs like Jamie Dimon call it bubble territory. The mechanics? A fragile system where one prick bursts the illusion. The tipping point came swiftly in 1929. September highs gave way to ease, overproduction rumors spread. Then, October 24th, Black Thursday. Volume surged, prices tanked 11%. Brokers called margins. Forced sales amplified the drop. Revelation hit. The boom was smoke and mirrors. By Black Tuesday, October 29th, the Dow fell another 12%, $14 billion vanished, equivalent to $250 billion today. Panic ensued. Banks failed. Credit froze. Echoes today. In 2025, signs flash red. Shiller PE nears .com levels. Articles warn of a "my bubble bursts." Imagine a trigger. Fed rate hikes spike, or AI profits disappoint. The turning point: when euphoria flips to fear, like a dam breaking. Sri Lanka's 2022 default, or Greece's 2009 crisis, show how debt ignites chaos. In 1929, it was the revelation that valuations defied fundamentals. For 2029, high debt, geopolitical tensions, and slowing growth could detonate. Bank of England notes sharp correction risks increased. The moment when the first big tech earnings miss selling cascades. The aftermath scarred generations. From 1929 to 1932, the Dow lost 89%. A $100 investment shrank to $11. GDP plunged 30%. Unemployment hit 25%. Banks collapsed. 9,000 failed, wiping savings. Global trade halved. Protectionism worsened the slump. Dust Bowl famines. Hooverville's human toll immense. Ripple effects. World War II roots in economic despair. Modern relevance. A 2029 crash could dwarf it. With US debt at $38 trillion, interest payments already top defense spending. Global debt $111 trillion, public defaults cascade. AI bubble pop. Tech layoffs spike, as seen in 2025 warnings from NPR on Shiller PE nearing 1999 highs. Inequality widens. Middle class erodes. Geopolitics heat. Trade wars echoes Smoot-Hawley tariffs. IMF fears disorderly correction. In 2025, consumer confidence dips. Job growth slows. Projections. Debt could hit 100% global GDP by 2030. Consequences ripple. Higher inflation. Stalled green transitions. Migration surges. Corporations hoard cash. Innovation stalls. Unlike 1929's four-year recovery, intertwined globals mean longer pain. Economists like David Rosenberg predict epic crash amid unemployment rises. Gold hits records as safe haven sign of unease. If unchecked, 2029 could trigger a lost decade. The 1929 crisis taught harsh truths. Bubbles burst when ignored. Reforms like Glass-Steagall curbed risks since he told repealed. Seeding 2008. Today's unsettling truth: we're repeating history with debt denial and hype. Escape demands action. Debt curbs. Diversified investments. Vigilance. Reflect. If 1929 predicted this, heed the warning before 2029 seals our fate. Could 1929's shadow fall on 2029? Share your crash predictions below. Are we in a bubble?